So, you want to get into investing, but maybe everything you've heard already sounds super complicated and it's left you feeling confused. But don't let it put you off. Investing is a great way to make sure that you're getting the best out of your money, and now's a great time to take that first step. So let's go right back to basics with these guys. This is George, and he's 20 years old. George has heard about investing, but doesn't know what it all actually means. Investing is buying an asset that you believe will go up in value over time. An asset is an item that brings value in the market, like a house or a stock in a company. A stock or share is a small stake in a company. For example, in the stock market, George could buy one stock of Apple, which means that George owns a small stake in Apple. And the stock market is where investors can buy and sell stocks of public traded companies. For example, Disney is a public traded company, because Disney allows investors like you and George to buy a small stake in the company. Meet Sandra. She's 31 years old. Sandra knows the gist around investing, but doesn't know which stock market exchange she should be investing in as an American. The NYSE stands for New York Stock Exchange. There are multiple exchanges in the world that enable investors to buy and sell stocks of public traded companies, but the New York Stock Exchange is tailored specifically for American public traded companies like Amazon and Coca-Cola. Sandra should invest in the exchange that corresponds to the country in which the company is listed. But just because Sandra lives in America doesn't mean that she can't buy Shell plc stock, for example, which is an oil company listed in the London Stock Exchange. Now this is Bob. He's 36 and he's eager to begin investing his $100,000 that he's saved up over the last decade, but he's not sure what certain investing terms mean, like asset allocation. Asset allocation is deciding where to put your money in the market. Traditionally, investors allocate towards stocks and bonds. However, Bob could allocate his money towards different assets that are available in the market, like real estate, or even riskier assets like cryptocurrencies. But Bob should bear in mind that there are assets that appreciate and depreciate in value over time. Examples of appreciating assets are stocks and real estate, and examples of depreciating assets are vehicles and machinery. Let's take a look at an example for Bob. With his $100,000 savings, Bob could buy a brand new Tesla Model S, which will go down in value each year, or buy a rental property, which will go up in value and rental income each year. But before Bob allocates his money, it's important that he understands this next term. Ever heard of the phrase, "don't put all your eggs in one basket"? Well, the investing term for that phrase is diversification. Let's look at an example for Bob, but imagine the eggs as money and the baskets as assets. Bob has $100,000 saved, and he's decided to invest all of his savings into just cryptocurrencies. His risk of losing money is quite high, because if crypto goes down to zero, then he'll lose all of his money. However, if Bob diversifies his $100,000 by allocating evenly into different assets like stocks, bonds, property, and cryptocurrency, then if crypto goes to nothing, Bob has only lost $25,000 from his savings and not all of it. By diversifying his allocation, Bob is protecting himself from losing all of his money if the worst should happen. This is Doris. She's 65 years old and she's fast approaching retirement. Doris has invested in risky assets all her life, but with retirement round the corner, she'd like to preserve her money by allocating towards less risky assets, like bonds, but she's not entirely sure what they are. A bond is a loan that you can lend to the government or a company, but what does that mean for Doris? The government will borrow Doris's money to put towards new schools, and in return, the government will repay the loan, as well as pay Doris a small reward for lending the money in the form of interest. Interest is the cost Doris would charge the government for lending them money. This can be a fixed or variable charge. Fixed interest is the rate that you charge for lending your money that doesn't actually change during the period of the loan. This enables investors like Doris to accurately predict how much they'd make. With the stock market producing unpredictable returns, having a guaranteed fixed income from fixed interest makes the asset less risky and appealing to older investors like Doris. This is Eric. He's 57, and he's searching for relatively low-risk investments in the stock market and has come across indexes. Eric seems to be talking about the stock market index, which tracks the performance of a group of stocks. It's the line you tend to see in charts like this one that indicates to investors where the market is going based on how well or how bad the stocks are doing collectively. The three most followed stock market index funds, or ETFs, which stands for exchange-traded funds that investors like Eric might be interested in buying, are the S&P 500, which tracks 500 of the leading public traded American companies, the Dow Jones Industrial Average, which tracks the 30 largest blue-chip American companies, and finally the Nasdaq, which tracks over 3,000 stocks. Companies can be labelled blue-chip or a value stock if they have the reputation of being profitable during good and bad times of the market, like Walmart or Coca-Cola. The majority of blue-chip companies tend to pay out a sum of money that's paid monthly, quarterly, or annually to their shareholders out of its profits, which is called a dividend. Eric might also be interested in mutual funds, which is similar to an index fund in the fact that it contains a group of stocks, but a mutual fund is actively managed by a fund manager. According to Investopedia, hedge funds, like mutual funds, are actively managed. Hedge funds, however, are private investments that are available to accredited investors. They are also known for using higher risk investing strategies with the goal of achieving higher returns than the market average for their investors. This is Mia. She's 25 and wants to improve her financial literacy to make better investment decisions. Well, Mia knows that a bull market is when the market goes up and a bear market is when the market's going down, but isn't sure what a growth stock is. Growth stocks are companies that are expected to grow in sales and earnings at a faster rate than the market average. Examples of growth stocks are Tesla and Amazon. Companies like Tesla and Amazon also produce financial reports every 3 months or quarterly to its shareholders that updates its investors on how well a company is financially doing. But if Mia is to remember one term, then it better be compound interest, which is when you earn interest on both the money you saved and the interest you earn. For example, Mia invests $10,000 in the stock market, and after 1 year of investing, Mia has made 10% on her money, which gives her $11,000. In year 2 of investing, Mia didn't invest any more in the stock market, but she still made 10% on her money again that year, and made $1,100 on her original investment, since 10% of $11,000 is $1,100, which means that Mia finished year 2 with $12,100 thanks to compound interest. So, from that example, after 2 years, Mia would have made capital gains, which is the profit she made on selling an asset that she held for over 1 year. This is Michael. He's 28 and he understands the basics of investing, but would like to know some more advanced terms like ticker symbol, volatility, and yield. Let's start off with looking at ticker symbols. A ticker symbol is an abbreviation for a company's name when it's listed on the stock market. For example, the ticker symbol for Apple stock is AAPL. Next, volatility is the behavior of a stock and how often it tends to go up and down in price. For example, if Michael bought an individual stock, then his portfolio would be going up and down in value far more radically compared to if Michael had bought an index fund, because an index fund tracks the performance of multiple stocks in the market. Finally, yield is another word for returns from an investment, whether it's a profit or a loss, but it's measured in percentage. For example, if Michael made $50 profit plus $2 in a dividend from an investment, then that means that he made $52 return, or a 50% yield on his original investment. I hope that's not too advanced for you, Michael. Now this is Mark. He's 45 years old, and his investing portfolio has a traditional asset allocation with a split between stocks and bonds, but he'd like to allocate into different assets, like real estate, despite not being very knowledgeable in the area. Oxford Dictionary defines real estate as property that has land and buildings on it. These are typically homes and office buildings. According to Investopedia, real estate funds are a type of mutual fund that invests in securities offered by the public real estate companies, which include REITs. REITs stands for Real Estate Investments Trust, and they're companies listed on the stock market that own income-producing real estate, typically residential real estate like homes and apartment buildings, and commercial real estate like office buildings and warehouses. REITs enable investors to have real estate in their portfolio without owning real estate themselves, and receive rental income profits in the form of a dividend. Another asset that Mark could allocate towards if he wanted to take on some higher risk is cryptocurrency. Oxford Dictionary defines cryptocurrency as a digital payment system that doesn't rely on banks to verify transactions. Examples of popular cryptocurrencies that investors tend to invest in are Bitcoin and Ethereum. After the terms were simplified, Mark feels much more confident about the idea of investing into different assets, but would still like to do some further research and learning that will support him in making the investment decisions that are right for him. But first, Mark decides to hit that like and subscribe button. Everyone has to start somewhere, so why not start now by checking out this next video.